Today's topic, physician side gigs. Now what? My goal is to walk through 3 important topics, ideas, strategies for those of you that have now or are searching for your first physician side gig. And my topics are as follows. Business structure, it's a big one. Taxes, Uncle Sam, and then investing. And this topic came from a YouTube comment. So what does that mean? It means use the comments. I listen. We respond to them. Besides the spammers, I know you're out there, but we also utilize them to build new videos like this one. So today we are building our video around side gigs, but not only side gigs, really important topics. And this is a conversation we have all the time with clients, but there's a lot of moving parts to it. And there's a lot of things to keep in mind because this is a really fantastic opportunity. But with that opportunity, you want to make sure you're taking advantage of it and doing everything appropriately. So we're going to get into all that fun coming up next. All right. So before we get into it, quick favor to ask of you, if you have not subscribed, please subscribe to the channel, click on the bell icon. You'll also get a notification every time we release a new video. As I noted a couple seconds ago, drop us a comment. We do listen. We build videos for you. We want to know what you want to see. So today's topic, again, came from one of those comments about a month, maybe 2 months by the time this video goes live, asking about more content on side gigs. So today you asked, we deliver. So first up, business structure. We're going to keep a lot of this high level because a lot of it is relatively simple once you start to put the puzzle together. But with all these things, make sure you're discussing them with your financial advisor. They might not have a YouTube channel, but I'm sure they're pretty darn good. Your accountant, your legal team, make sure your whole team is on the same page here. But first up, business structure. So to me, there's 2 common ways to look at it, but the other way has like another layer to it, which again, I don't even think most people understand that. So first up, how are you going to structure this? Well, you could be very simple. You can keep this as a sole proprietor, right? It could just be you. It's just your name. You're a sole proprietor. Now, if you go that route, you should also add an EIN number. So this is an employee identification number through the IRS. This is a very good tool to have in place. One, because instead of you listing your social, everything, you're going to have this new little tax ID number. But more importantly, once you open the solo K that we're going to discuss a little bit further down the line here, you'll have a form called the Form 5500 that comes into play once the account goes over $250,000. So getting nerdy, a little bit longer term, but still, that's why getting that EIN number is very important. Now, for most of you, that might be the route to go because a lot of people get a little bit stir crazy on the LLC idea. Let me use an example here. A lot of people think that, oh, I have an LLC, so if I hurt someone or do something bad, I'm in a good spot. It doesn't work that way, right? So an LLC, in the most simple example, and this was explained to me by an attorney many years ago, but I use this example all the time. But you are a physician, you have a side gig, you open up a storefront for your side gig. You just got done mopping the floors, but you forgot to put out the yellow sign. Someone walks in, slips, breaks their butt, they sue you, they win. You were a sole proprietor. We have a problem now. They likely can come after all of your assets. But other example, never mind. You have an LLC set up. That LLC can safeguard you for only the business assets, right? They can come after those business assets, but not all your personal assets. Now, just because you have an LLC does not mean that you have this ironclad fence around you. You still have to run it like a true business, right? You can't be commingling expenses. You can't be doing, oh, well, my business credit card, I'm just going to cover my kids' tuition. You got to run it like a true business. And that's where you'll start to see what we call pierce the corporate veil, right? You set up an LLC, but you didn't treat it like a business. So you could still be in some trouble there. So most of our clients, most of the conversations we have around the LLC is it's not that they're going to get an extra form of asset protection, but it gives them more structure to their business entity, right? They create their business name, then gets its own tax ID number. You then go open up a separate credit card for that. And that's where it gets really powerful, right? Because as a sole proprietor, if you go open up a bank account, it's still in your name. You go open up a business credit card, it's still in your name. So for most of you, you're likely going to end up opening an LLC, but my emphasis there is it's not on the asset protection side of it. It does have some asset protection, but very rarely does their side gig require some type of storefront, right? It's usually just kind of built into their day-to-day activities already. So that is the one thing to keep in mind. You have a sole proprietor, you have LLC. The larger the business gets, the LLC is going to probably make a lot more sense. If you made random 10 grand here or there because you did this or you did that, you did expert medical witness work, but you're probably not going to keep doing it. You probably don't have to get crazy with the LLC, but if something you really want to build up, those numbers are going to continue to grow. LLC can make a lot of sense. Now, another common question is, well, I don't want an LLC, I want an S Corp. Well, that's where the confusion comes in. S Corp is just a tax filing, right? You're going to have an LLC, but then you're going to ask to be taxed as an S Corp. Essentially, you file an extra form that says this. So just keep that in mind that an S Corp is not a separate business entity per se. It's actually just a tax filing status. Now, my note with S Corps, again, confirm this with your accountant, but I do think that some accountants get a little bit crazy on recommending S corps, and I think part of that may be, again, my industry is known to make things very complicated that probably aren't that complicated. Kind of the same nudge I'm going to give to accountants here. They make it extra complicated so that you don't leave. An S corp will make a lot more sense as the income really grows, like the business really starts to grow, because your main win with the S corp is going to be that you pay yourself a reasonable salary and then you take business draws. The business draws are going to have a little bit better tax rates than your actual salary. So if you're just making $20, $30, $40,000, an S corp is probably overkill, because then you got to set up salary, right? You got to set up payroll, you got to run your payroll through that. But even there, how much extra can you take as a business draw, right? You're already a physician, so you're going to draw a pretty good number here. But keep in mind that the IRS also doesn't say like, hey, just because you are a pediatrician, but you're also doing physician expert witness work, your salary should be $45,000 per year based on you only doing it X year. They don't give us those details. That's the gray area of tax planning. But the first topic, again, covering here is that business planning. Very low income. You could be okay with the sole proprietor. Key thing there is at least set up a separate EIN number. Most of you will likely lean to an LLC, not for the asset protection per se, even though that can come into play, again, if you have like a storefront or something like that, but a lot of it just to create really that nice, tight business entity. And then as the income really cranks up, that S corp can make a lot of sense, because that's when you start to pay yourself a reasonable salary, and then you're taking draws on top of that. So again, high level stuff, work with your advisor, your accountant, your team to really fine tune that. But that should be some really good food for thought, and it also give you a lot of good ideas going forward, whether you're just starting a side gig or you're thinking about getting a side gig started up. All right, next up, taxes. This is a big one, because remember, in this side gig conversation, we're assuming that it's 1099 income. If you're watching this and you only have 1099 income, this section is even more important. But here's some things to keep in mind with taxes. With 1099 income, remember, nothing is being withheld. If this is your first time getting 1099 income, that is probably one of the biggest shocks to the system, because you've been used to getting paid W-2. What's the nice part about W-2? All the taxes are being withheld. You don't have to worry about a thing. All of a sudden now you earn 10 grand, 10 grand hits your bank account. You're thinking payday, let's go. Not so fast, because you're likely going to pay, depends on a lot of things, but I always say you're probably paying somewhere between 30 to 50% in taxes on that. Part of the issue is you're going to pay something we call double FICA taxes. So this is essentially your employment taxes. So on your pay stub, usually as a W-2 employee, you only pay half of these, your employer picks up the other half. But as a 1099 income, you're both. So you got to pay both. So that's usually, we'll say, anywhere from 30 to 50%. The higher your household income, the closer to that 50% number is going to become very real, right? Your highest marginal rates, you could be anywhere between 30, 35% right now. You're going to have some state income taxes there, depending on where you live. You could have some local taxes. But again, you have that double FICA tax. So that alone bumps you up to 15.3 just on its own. So that's where you should be leaning maybe more towards that 50% number for most of you. Maybe some of you can make a little bit lower, but keep that in mind. You need to, if you get paid 10 grand, for most of you, you should be setting $5,000 aside right away for taxes. Now, the next layer to that is something called quarterly taxes. Again, if you're used to W-2 income, this is something you've never seen before, but 4 times per year, Uncle Sam says, hey, based on that 1099 income and other things, you got to pay some taxes now. So you got to get your quarterly taxes in line. That is a really important one. And you can't just play catch up, right? You can't say, I'll just pay everything on Q4, because it's a weighted number. So when you file your taxes, there's a form in there that says, did you pay enough at Q1? Did you pay enough at Q2? Did you pay enough at Q3? Did you pay enough at Q4? If you try to play catch up on Q4, it's not going to be weighted properly for you. So just keep that in mind. Now, while that's all very scary, you've just unlocked a new level of tax planning, because you can deduct a lot more stuff now against that 1099 income. You remember that CME trip to Hawaii, but no one reimbursed you for the airfare? Not anymore, my friend. You're getting reimbursed. Well, by reimbursed, you're going to at least get a tax deduction. So here's some things to keep in mind. First and foremost, one that I see missed all the time, home office deduction. Physicians, you do not have a 9-to-5 job. You don't just do work in the hospital from 9 to 5, right? You're going home, you're still typing up stuff on your computer, you got notes here, you got a call here. You have a lot of ongoing expenses. So home office deduction is one of my favorites. I am a big fan of tracking all the expenses and then providing those to your accountant, and then they do their math, and they get all that number organized. But there's also a simplified version, which is much easier to explain on a YouTube video. Simplified version is this: $5 per square foot up to a 300 square foot max. Do the math, $1,500 of possible deductible expenses there. But if you're in the 35% federal tax bracket, all of a sudden, that's about $500 off your tax bill. If you believe your number's above 1,500, you can also itemize those expenses, right? You can list, hey, internet for the office was this for all the 12 months, electricity was this, water was this. I'm trying to think through all my own personal stuff. Actual mortgage interest expense, right? That's all listed in there. So if you think you're going to be above 1,500, list that. And you have to have an actual office. You can't say, well, my bedroom's 500 square feet, so I'm actually going to use that because I actually do most of my emails from my bedroom. You need to have an actual dedicated space. So that's one that we see missed quite a bit. But just keep in mind of all the other business expenses, or as I like to say, if it's legit, list it. So here's a few that we list, right? Computers, stethoscopes, scrubs, cell phones, cell phone plans, CME, travel, licenses, any type of business expense should be listed in there. The most common one is health insurance, right? Now, if you have health insurance, so let's just say you're an academic physician, you have great health insurance, you're not actually buying anything through the 1099 side. That's different. Let's just say you do get reimbursed for CME. So your actual W-2 employee does reimburse you for CME. Don't try to deduct that then on your personal side, like on your 1099 Schedule C. Just keep that in mind. Don't double dip. But health insurance, if you are paying for health insurance out of pocket, sure, legitimate expense. But don't say, hey, the insurance I was paying through my W-2, I want to deduct that on my 1099. Again, you don't want to double dip there. But one of my favorite things about this 1099 income is you're now a business owner. You get a lot of the tax planning benefits that come with being a business owner. So number 2 on our list is the overall tax planning. There's a lot there. That is truly just skimming the surface, but that should give you some really good takeaways. The amount of times that I review a client's Schedule C and they'll put, well, I had $50,000 of side income and my net profit was $50,000. We sit there and we say, for the most part, it's impossible, right? You had some business expenses for sure, but keep that in mind. If there's legit expenses, list those on there because you now have a spot to really take advantage of those legally. All right, coming down the home stretch, investing. So you have all this new income coming in, you got the money bags going. What can you do with that 1099 income? Well, you now have access to one of my favorite accounts, the solo 401k plan. So with that 1099 income, you get a whole new investment vehicle, which we call the Solo K. Now, for some of you, maybe you've already used a SEP IRA. Maybe your accountant told you to use a SEP IRA. If you go through any of our past videos, any of our past blog posts, we will favor the Solo K over the SEP for numerous reasons. But the main reason being that the SEP IRA will block your backdoor Roths. And we love backdoor Roths. So that's why we are big fans of that Solo 401k plan. And you get a whole new mix here, right? So if you were putting $23,000 into the 403b, you can now do a separate $23,000 into your Solo K. Not only that, now this is based on 2024 limits. If you get into the employer, so an ER ending, not an EE ending, you can actually get the whole way up to $69,000. Now it depends on your income. There's a calculation there based on the net profit, but this is where you can really crank away money into that Solo K plan. Again, we are bigger fans of the Solo K than the SEP IRA. I'm not going to go through too much more than that, but just know that you get this extra bucket. And I know 23,000, but heck, if you can get an extra 5,000 in there, if you're doing these pre-tax, that is a tax deduction. So we just went through the tax section. One of the best tax deductions you have at your disposal will be this extra retirement plan. Now, depending on how you set up, maybe you decide to go Roth there. We're still pretty big fans of saying, hey, you're at a very high income level now, high tax brackets. Let's deduct everything now. And then once we get later down the line, later in life, we'll have this beautiful window to start doing some Roth conversions. We'll nerd out at that point. But at this point, keep in mind, Solo K, great extra bucket. If your income is very high, you have a lot of 1099 income, don't forget about something called a cash balance plan. This is what we would label as a defined benefit plan. So different than your 401k, 403b, which are labeled as defined contribution plans. Defined benefit plan is kind of like your old school pension plan, is how I always like to describe it. But if you think the numbers are attractive for that Solo K, cash balance plans, now it's a whole formula. We bring in actuaries. It has some moving parts to it. You could get another $100,000 to $200,000 possibly pre-tax into this cash balance plan. That gets very attractive for some of the higher, it's very attractive in a lot of places because federal taxes are our highest. But for some of those states that have higher tax rates, looking at you, California, looking at you, New York, this can really be something that stands out. So if that 1099 income is very high and you're already maxed out the Solo K, you're getting the whole $69,000 in there, you might want to check out that cash balance plan, which could give you a whole nother level of tax planning and also investment planning. Those are the 3 main topics I wanted to cover, just a little bit of investment in there to finish it off as well. And there you have it, 3 huge topics. We could probably do separate videos in each topic alone inside of those 3, whether it's the business creation part of it, the taxes, or the investing. But side gigs, one of our favorite things, whether you're completely 1099 or you're W-2 with 1099, and I usually make the joke, one of my favorite clients, avatar client, is academic physicians with side gig income, because there's a lot of benefits that come out of that academic side in terms of retirement accounts. But then if you add in that 1099 income, you unlock a whole nother level there. So there's a lot of neat planning items that come with that. Side gigs are a very popular topic. It's a huge variety, right? Well, if some clients clients that have a couple thousand here or there. We'll have clients that are making six figures as side income off of a main W-2, or clearly all 1099 income, bringing in the big bucks, 500, 750,000, $1 million of 1099 income. So there's a lot of tax planning, a lot of strategizing that can be in there with a huge range from based on those numbers I just said there. So wonderful topic. I love this topic. If you have specific questions, drop those below as well. This is one that I love to build on. It's a really good topic. And thank you again to the individual that dropped that comment in our YouTube comment so that I could actually build a video on this. That is how I love to build content. So thanks for hanging out with me for the last 15 minutes or so. If you have not subscribed, please subscribe. If you want to see a certain topic, drop that below. But again, thanks for hanging out with me, and I'll catch you on the next video.